Well said. Thanks to everyone. And welcome everyone. Welcome to our advisors from coast to coast to our second edition of Let's Talk, featuring today Dan Bastasic. Also a special shout out to my colleagues over at IA Clarington. We're happy to have all of you on the line here today, and certainly proud to have you, Dan, join us. Just a few quick housekeeping items before I introduce you here, Dan. There's a Q&A box at the bottom. If you would like to ask any questions of Dan, hopefully we can get to those. Those that we can't, we will do so at the end. Any of the topics, presentations, or things spoken about today in today's webinar, which will of course feature Dan at the beginning, we will be sending out to you at the end of the presentation. And we will also feature our new estate planning tool, which will be sent out to all advisors afterwards. There will be CE credits, and I will get right started here with Dan. It's our second edition here, Dan. We're extremely excited to have you here. I'll do a quick bio, but we had you here last November 16th or 17th, and we said to advisors, it's a great time to buy your fund, and it sure has been. So Dan's been with IA Clarington since 2011, is the lead portfolio manager for the IA Clarington Strategic Funds and Clarington Tactical Income class. He specializes in equity income, high yield corporate bonds, and investment grade corporate bonds. He has over 20 years of investment experience, holds a Bachelor of Commerce, Finance, and Master of Business Administration from the University of Windsor, and a CFA designation, and a member of the CFA Society of Toronto. And of course, Dan, we're speaking about your real specialty, which is the fixed income side, which has been a lot of talk about. And also you're going to talk about stocks for the next couple of years. So Dan, I'm going to turn it over to you. Welcome, and it's a real pleasure. You did exactly what you said when we had you on in November, and that's outperformed. So our advisors are excited to hear more from you again.
Great. Thank you, Mark, and thanks everybody for having me on today. Really going to do a bit of a continuation of where I was last year. I know I did this event for you in November, and really some of the things that I talked about last year in terms of our funds and the way things were going to work out, started in May and June, and that's really when the big change happened. Not only from the market's perspective in terms of what was going to, revert back to the mean or start to outperform, and then certainly how it was going to affect our funds and our clients' portfolios. So I'm going to continue that discussion because I think there's a number of things that need to be put in perspective. One of the things is we in different, I'm a little bit different, I guess, than some other maybe managers or people that forecast the future. I like to look at the future in 12-month increments. It keeps me active, keeps me in front of where, the old Gretzky saying, in front of where the puck may be going instead of where it's been. And it's really been a core part of how we've managed our clients' money, and certainly been a big part of our success. So I want to talk a little bit about the equity markets and the bond markets, in particular, what we're doing over the next couple of years. And it's really a tale of two stories. We went through everything that we went through last year, but when you're looking forward, we've got a story on the equity side and on the corporate bond side, and then, which is a market side, and then we've got a story on the economy side. And they're generally going to, in my opinion, move in the same direction. However, what you're going to likely experience over the next couple of years is more or less this sort of stair-step motion in terms of returns and where they're coming from, and certainly taking into consideration risk, which we do to earn those returns. I think you're going to have a tail on the economy side. You're going to have a tail on the market side, and being active and sort of strategic about where you want to allocate your client's capital will have a big impact on forward returns. So I'll talk a little bit about that. We should talk about what's driving the markets, liquidity and earnings. Of course, at some point they'll probably taper off a bit, but we'll talk about that in a bit. Interest rates, inflation, all the things that can create this stair-step motion in the markets, at the same time having a really strong economy, especially when we're looking at over the course of sort of the last 5, 10, and 20 years. So I'll go over some of the things that I think are going to move that. there are opportunities. I think our fund has exposed some of those opportunities since last June. I think those opportunities will stay with us, and I think the way we structure our funds and the way they're structured currently will probably, hopefully, do well during this period. I'll go over some of that in terms of where we're at, and certainly low duration, something I'll talk about. We are a low duration. I'm generally a low duration type manager, and I'll explain really what that means and put it all together and sort of tie it all up so we can all sort of follow along with what our strategy is and what my strategy is over the next several years. And then finally, I'll talk about our funds and basically our history of performance and then how certain things happen every sort of 4 or 5 years where we underperform for typically a 4 or 6 month period, and then we sort of get back to our basics of doing pretty well for our clients for the next 4 or 5 years. And I think we're at that point. So let's look at the economy, and there's a couple of big elephants in the room that are going to drive the economy for a number of years. And, one of them is like, and remember, put this into context in terms of what you hear every day on television. Like every day it's something that's going to derail this or improve this. And look, at the end of the day, financial securities are driven by liquidity and by money. And when there's more money than there is growth, that money has to go somewhere. And generally it goes into stocks, corporate bonds, that sort of stuff. And that's really the point right now. So I put up this chart in terms of money supply. And the reason I put this, we know what it is. We know that there's a ton of money supply and everybody's stimulating, but sometimes it's really hard to put it in perspective. Now, I bring this chart up because it's putting things in perspective. You've got, we've got about 25% money growth. But you put that in perspective, that's 4 times the sort of historical average of about 6% and 2.5 times more than what we saw in the early 2000s and during the great financial crisis, like 2.5 times more. And so, the point that I make here is this money has to go somewhere, and this is happening all over the world. It's not just happening in the U.S. and by default in Canada. And what it's leading to is, the benefit or the symptom of synchronized growth. Now, we go through these periods historically where synchronized growth, by the way, is very, very powerful and affects a lot of different things. It gives you confidence that the economy will be there for a bunch of years to support, markets for several years, and certainly to create buying opportunities when there are corrections in the markets. So this whole notion of synchronized growth, which we are starting to see now, and of course, as the vaccine continues to roll out globally, we'll continue to see more of that. And then you've got this massive amount of money supply that has to go somewhere. And so, I'm really positive on the economy for at least the next 2 years. And we can get into some of the things that can derail it. Maybe during question period, like inflation could derail it. I don't think it will, but there's a number of things that could slow it down. But certainly from a top-down perspective, this is something that's really hard to overcome if you're trying to assess risk in the market. And this is important for us because what I'm trying to do is avoid the torpedoes for our clients. I'm trying to identify when things can go really wrong and they can stay wrong for a long period of time. And so this is I think this is a very positive thing. And of course, this has led to, short-term bubbles in different parts of the market, not in the overall stock market, and I'll contend that that's not what's happening. But certainly Bitcoin had a pretty big day in the sun over the last couple of months. Lumber is having a big day in the sun. High short interest volumes were bubbling in January and February. So when you have this sort of a scenario, as I said, when you've got way more money than you do growth, generally in the economy, it's got to go somewhere, and it's going to create these bubbles. They shouldn't worry you unless they sort of make the way into the economy or they make their way into different sectors, big sectors of the stock market. And I think that's what's going on. And certainly it's starting to slow down in the last month, which is pretty good news. So we've got that part of the economy, and we can go into a bunch of different stuff, but this is really important to me. Especially over the next couple of years. And then we've got the next slide, which is looking at, well, what about the consumer? Now, I always focus on the consumer. And the reason is because in the US, it's still about 72% of the economy. And of course, by default, Canada follows. It's about 20 some odd percent of the global economy. So the US consumer really matters. And what really struck me last year when I was trying to assess how long we can be in this Goldilocks type scenario is that there's about $1.5 trillion in excess savings. And you see that in some of the retail numbers. And every time the government sends out a stimulus check, retail sales and things spike up and it gets back into the economy. But the point of this is that when you put it in perspective, and again, words are one thing, perspective is another. This excess savings of about 1.5 trillion represents about 7% of total GDP in the US. So you've got huge amounts of money supply, liquidity. You've got huge amounts of excess savings. You've got an economy that continues to open. We're still not even close to being there yet. So that's going to continue to drive things economically. And so what you're going to get is a couple of things. You're going to get an economy that has tons of tailwinds for years, but you're also going to be put under pressure to pick and allocate investors' dollars to the right sectors based on these things. These things, in the current form that they are now, from my perspective, tell me that, the whole market outside of interest rate sensitive bonds is probably going to do well this year. But next year, as things start to change and unwind and normalize, you're going to have to be really good with where you allocate consumer dollars in order not to underperform. So this year, I think, you can generally overweight some pretty good stocks and bonds and you'll do well. Next year, you're going to have to be a little better at allocating. And this is sort of what's on the forefront of my mind in terms of when to do that and where to put our dollars 6 or 7 months ahead of time before these things actually start to take hold. But the point of the matter is that there's just a lot of money out there and it's got to go somewhere. And this is where it's going to go. And, we have a backdrop of liquidity, but we also have a backdrop of interest rates. And again, this whole notion of where's the risk, where do we allocate dollars, and then what's the macro environment telling us? What will be the disruptors to our thesis, to anyone's thesis? Well, you look at interest rates, and this is a couple of months old, but it still tells a story. It looks back about 5,000 years. It clearly tells you that interest rates are about as low as they've ever been, as far back as you can possibly go. So although interest rates may drag themselves on a 10-year around the 1% range, it's probably not going to go negative, especially with what's going on with liquidity. And certainly from this chart, it's got nowhere to go but positive. And this is likely going to, be the trend for the next, call it 10 years, maybe 15 years. These cycles generally last about 10 to 15 years, sometimes 20 years. Think about why growth and why government bonds or interest rate sensitive bonds did so well for so many managers in the 80s, 90s, and the early 2000s. Interest rates went from 12% to 50 basis points. So that's a huge tailwind of support. Now, luckily we did well in that environment because we're active in the way we invest. But if you weren't long interest rate sensitives during that time or growth tech, you really have to do a great job picking the right stocks and the right bonds in order to keep up with that massive tailwind that some parts of the market had. I'm suggesting that you just, again, put this in perspective. It's got nowhere to go really but up. And I'm not suggesting 4% rates, but I'm certainly suggesting that at this point, this is not the moment to overweight interest rate sensitives, whether it's on the stock side or whether it's on the bond side. And certainly we are not doing that. We have not been doing that for the last, 9 or 10 months, or roughly since June. I guess it's about 8 or 9 months, roughly since June of last year. And because of this, there's a couple of other implications in terms of returns and performance. You think about where Fed rates are and interest rates are very low for the next couple of years, you're going to have to get your yield from equities and corporate bonds. I mean, that's the place you're going to likely have to go to get yield as this sort of picture unfolds. And certainly right now, when you look at the yieldy part of the stock market, there's still 10 to 15% of capital gains just to revert back to the mean in terms of spreads. So the spread of the dividend yield relative to governments, there's still a lot of mean reversion. The spreads are about as wide as they've been in some cases in 15 years. And that includes financials as of 2 months ago. It's a little different today, but as of 2 months ago, it includes financials as well. So these are the sort of things that, and the sort of strategies, I think, that are going to be important over the next couple of years. So, those are sort of the macro and economic variables that are at play. And so then you have to ask yourself, how does that lead to? So we've got a very positive macro liquidity consumer environment. How is that going to play out relative to stocks? And for certain, you have to look at earnings, right? And we know with relative certainty, and certainly first quarter of this year has given us more proof, the year-over-year earnings growth is going to be among the best it's ever been in the next sort of 5 and 6 quarters, or 4 to 5 quarters. And we don't know that for certain, but certainly if things continue to progress the way they are, I think it's a pretty fair bet. So we know that the stock market, even though its valuations are historically high, we also know that earnings growth for the next year and a half, is going to be pretty strong. And the earnings are likely going to grow into that PE valuation, if that's the way you look at valuation in the stock market. So you've got that perspective. The other perspective is, and something that's not talked about enough is, look, price to earnings ratios go up by a multiple of a couple of times every time interest rates come down by 50 or 75 or 100 basis points. So, if I put history into perspective at a 1.5% 10-year bond, and I might get this wrong by a little bit, but you'll see what I mean. The PE of the S&P 500 is generally somewhere around 22 times. That's roughly where it is today. So from a valuation perspective, I think the earnings picture is going to grow into the valuation. Now, this is key because what I'm talking about is, do I need to worry a lot for the next 6 to 9 months? Probably not. Do I need to prepare our clients' portfolios for the next 12 months to 18 months after the next 5 or 6 months? Probably so. And what I mean by that is, so you've got a lot of safety in the earnings and in the economy here, but there's going to be a couple of things that may change on a short-term basis the direction of market returns. Inflation, is it transitory? Is it secular? Again, I can have a more wholesome discussion on that at the end. I think at the moment it's transitory. Could get secular in 5 or 6 years, but we can talk about that. Certainly rates, that's going to be the next knee-jerk reaction, I think, to rates going up. PE multiples should be lower, and the timing of that versus the economy and versus earnings, it could provide a reason for a bit of a sell-off. I mean, I think right now we're probably due for a bit of a correction, but it likely won't be 10%. It'll likely be 2 or 3 or 4% max. But certainly these are the sort of stair-step market reactions that we're going to get likely for the next, call it 6 months to 9 months towards the end of the year. Now, I want to finish off with one thing. And again, let me finish off with 2 things. One is that the highest growth in these earnings are going to be in those sectors where we have a lot of weight in and which we benefited from in the last 6 or 7 or 8 months, which is financials, industrials, consumer-related stocks and bonds. Healthcare had a nice run, but we have a lot of weight in healthcare. We've reduced it a bit, but we still think that's going to do well. And cyclicals in general. So, and before I move on to the next slide, people talk to me a lot about being a Canadian investor. Well, the way we structure our portfolios is generally to take Canada for what it's good for and then take everybody else globally what we're not good for, and we sort of combine those things together to create a really well-diversified strong portfolio of stocks and bonds. If you think about this unfolding, Canada is the cyclical market of the world, right? I mean, we get a bad rap, but if you believe that there's going to be accelerated growth, tons of liquidity, cyclicals are going to do well, commodities by default will do well because if there's a little bit of inflation, your emerging markets or Canada, I take Canada 98% of the time because historically Canada does well in that environment and it doesn't, and if it's wrong, it doesn't go down as much. Last point I want to make, because I know this one's up there, is the market overvalued like it was in 2000? You have to put this in perspective. I was there in 2000, as part of my whole learning and experience throughout my career. I was also there during the great financial crisis. What's different about today's market, and again, put in perspective, than early in the 2000s, is everything we're doing right now, we're troughing. Whether it be employment and employment growth, interest rates, earnings, inventory, everything is troughing in today's North American markets and generally across the planet. Now that's different, right? In 2000, we had tons of inventory of everything. Rates were going higher and higher. Inflation was trending up. Valuations were through the roof. We didn't have a cycle of earnings to catch up. We had the earnings growth in the late 1990s. So it's completely different. And I wouldn't judge the early 2000s with today's market. We'll get there, and then you should judge it that way. But my opinion, we're 2 years away, maybe 3, maybe 4. But we're certainly nowhere within the next 12 months on that front. So I want to switch now a little bit to high yield. And so you can tell where we're invested. We've got a lot of value, not value by purpose, but just value, whether it's just the cheap price we're paying for different stocks and different sectors in order to put our portfolio together. So we've got things that are going to benefit over the next 12 months to 24 months to 3 or 4 years with everything that I've talked about. But when you look at fixed income, there's some risk there if you are, as I talked about, if you're an 80s, 90s, and early 2000s investor where interest rates went straight down, you've got risk if things start to normalize a bit over the next decade. And the risk is an interest rate sensitive stocks. So, we prefer, and we continue to prefer higher yielding corporate bonds. Now, this is the index, and I put this up all the time to give you some perspective in terms of, what to expect in the index for the next 12 months. This is, I think we're likely going to be in the index somewhere around 5.5%, if all else being equal. But certainly you look at your opportunities in government bonds, and even with a very modest increase in interest rates in the government bond side, you're going to have losses. So we prefer to get our yield and with a low duration for our clients in the corporate bond space. And there's a lot of reasons to believe this is going to be sustainable. All the reasons that I've talked about that'll push the economy into strength are exactly the same reasons you want to own higher yielding corporate bonds. And with rates low, inflation going up, believe it or not, inflation going up is a good thing for higher yielding corporate bonds because they get to inflate away their debt. Their credit ratings go up, their yields or their spreads generally contract. So these are the reasons why we continue to prefer high yield. And the other thing is the index is much higher quality today than it was over the last 25 years or so. So the spreads are naturally going to be, like, the fair value of spreads should be lower in today's higher yielding corporate bond market than they have been in the last 20 years. Just because the nature of the index has gotten more high quality than it has been. Now, so what have we done for our clients? And you look at where our strategic corporate bond is. And by the way, in our strategic income fund, the equity fund, we generally have the same strategy and many of the same names that we have in the corporate bond fund in that fund. We view fixed income investing as an alpha generator, not as a hedge. And because when we're looking at these names, when we're looking at these securities, we're looking at the businesses themselves and whether they're sustainable or not, and then how much yield and how much capital gain by investing in these organizations can I get for our clients? And at the same time, what is the risk of something going wrong? So when you look at where we are, this is where you want to be. You want to give your clients a high yield, but you want to have a low duration. So duration is what is the sensitivity of interest rates, right? And so you look at ours, our duration's about 2 in a corporate bond fund. Most corporate bond funds are, anywhere, they're anywhere between 4, 5, 6, 7, 8, and the government bond, a 10-year government's about 9.5. So we've got a 2. So we're really low sensitive to increases in interest rates, yet, we're giving you 4 times roughly the yield of a sort of 1 to 5 year government bond or corporate bond index. So we're giving you a ton more yield in a great economic environment with really low duration, which should provide a lot of protection against interest rates going up in terms of capital losses. So the macro strategy, our thoughts on that, and then we put it into play when it comes into our clients, portfolios and our clients' investments with. So, and then you look at where the year-to-date returns are. There's a couple of points that I want to make here just to put this in perspective again. We're as of last week, we were actually ahead of PH&N. This is as of the end of March. We were neck and neck with PH&N. So you can see how we are relative to much of our competition. We're way ahead. And these themes are going to continue to play out. If I'm right about all the things that I've talked about, where we're structured in our fund is likely going to continue to contribute a lot of alpha to our not only balanced fund, but our corporate bond fund. Now, in 2001, I had a presentation slide that I was pushing out to clients, trying to get them on board with investing with my high yield corporate bond fund. And I had a slide that said one person's junk is another person's, and then I listed our top 10 holdings. But I want to give you some perspective in terms of some of the names we own. So people call high yield bonds junk, but you look at some of our largest holdings like Mattamy Homes, consumer related, huge working capital, positive working capital when things don't go well, when people aren't buying houses, which is a massive risk reducer. And that's what you want to see in a company and especially in a bond. And it's returned about 8.4% in a BB plus rated name over the last 3.5 years. Mattamy Homes is everywhere. This is a large inventory, large land inventory, lots of collateral type organization producing equity-like returns without the risk. You look at Superior Plus, utility-like, Brookfield Asset Management has invested quite a bit of equity into Superior Plus in the last year. They see things as I have seen things. I've invested in Superior Plus for 20 years. This is a high-yielding, high-quality utility-like business that is giving you the extra 3% carry in terms of yield compared to some of its other competitors just because of the rating it has. And then certainly Cascade, for people that are in Quebec, very familiar with Cascade. I've been an original investor in Cascade since 2000. You look at this company, this is not junk. A large percentage of their business is in tissue paper. And if I have not yet found the more sustainable business than going to the washroom. So this company produces tissue paper that you use, a lot of it when you go to the bathroom. So these are things, and I'm not saying that to be funny, I'm giving you an example of, this is the type of business we want. Sustainable, free cash flow positive. I can count on them to continue to pay our clients every year, year after year, and I want the extra yield given the investment that we're making in the company. So those are the things that are going into the portfolio from a bond perspective. Now, I want to finish, it's my last slide, sort of rehashing what I put up for this forum back in November. And a couple of things I want to highlight is, if you look at this only goes back to since I joined Clarington in 2011, but if you if you go back to the year 2000, my 21-year sort of management history, the numbers play out about exactly the same. Every 4 or 5 years, because of the way we structure our portfolios, the companies that we buy, we have a hard time fighting a flow of funds, 3-month or 4-month type time period like we did in 2000. We had a portfolio that should have done extremely well with the economy tanking, but it wasn't a normal economic tank. It was a pandemic that shut everything down. So, we ended up not having enough tech, not having enough gold, and we had these businesses that are going to be around for 40 or 50 years at least, that didn't do well, that should have done well. Well, that's why I was with confidence in May of last year saying, this is an opportunity to buy our fund. This happens to me all the time. It's every 5 years or so, I have a 3 or 4 month period where I lag, and it's a buying opportunity because the companies we own are not going away tomorrow. They cannot be substituted, what we're owning, the businesses that we're owning. So I wanted to highlight that because you could see, again, even though we finished okay last year, because of the structure of our fund, we're sort of at the top of 600, 700 competitors over the last, since June of last year. If you look at since June of last year, we're, top decile in terms of performance. Now, I think that's going to continue because of the way we structured our portfolio. We've got yield, and we think yield is going to be in demand because of all the reasons I talked about. The spreads are wide, and your alternatives in terms of yield are very, very low. We have 2 times the amount of what you would consider defensive yield stocks than the index has, more than 2 times. Now, they're not going away. You need yield. You can't get it from governments. They're not as interest rate sensitive because they're relatively low duration businesses because of the higher yield. And they still have the reopening trade and all this liquidity that's going to likely go their way for the next couple of years. And by the way, if inflation goes up and interest rates go up, gold and tech are going to lag. So we've got a ton of exposure to those other things that are likely going to outperform. When I say lag, I don't mean go down 30%. I mean, there are going to be better places when the market's normalized to put your clients' dollars, I think, until things change. So that's the way the portfolios are structured. We are mostly hedged in terms of our currency exposure. We never go under 50. We're currently about 80% or so. We're generally, we'll probably switch to closer to 90, 95% the next month or so, but we never take a risk on currency. It's just too hard to make that up with good security selection. Our cash is about 10%. Again, I think there's going to be softness in the market for the next little bit. And when you look at our portfolios, we've got about 30% foreign exposure, but about 45% global exposure to revenues. And again, so this is how I get a global diversified portfolio together, even though the parameters of the prospectus say, he generally can't go more than 50% or whatever. And certainly the category says 30%. So we've got about 45%, 46% exposure to global businesses and just over 30% exposure to, roughly 30% exposure to, global domiciled companies, roughly. So this is the way we put the portfolios together. And I want to give you a couple very quick examples. I gave you the bond examples. Now, this is our portfolio at work, right? Consumer strong, tons of liquidity, backlog and housing. So, names like Carrier, which is one of the global leaders in HVAC. We bought that. We owned it when we owned Raytheon, but we added a lot more to it when Raytheon spun this business off. And you look at it, it's a global leader in HVAC and security with a ton of pent-up demand in housing, a ton of pent-up demand in consumer wealth that's going to be put into the housing market. There's about 4 million houses starts that we're behind on in terms of to catch up to normal levels. So that's all going to play into names like Carrier. And, they've got 50% U.S. exposure and 30% Euro exposure. Europe is at the front end, the beginning of this recovery. And the rest is sort of globally dispersed amongst Canada and other countries. And you look at this company, I mean, you look at this company, it's returned 200% on our investment in the last, 1.5 to 2 years. It's not Tesla. This is an HVAC company that's got a lot of safety in its business, and valuations are cheap. It's probably, according to my estimates and our estimates, we're probably 25% cheap on this company relative to its peers, and it's reducing debt. So these are the types of companies where I talk about the economy, I talk about the markets, I talk about the next, 3 to 4 years, and then we try to find those businesses that are not going to surprise us to the downside. Another one is Waste Connections, utility-like business. Again, this is picking up your garbage. And we know that the shutdown has had a negative effect on that. So as we open up, they're going to start to normalize, and they're going to start to return to normal in terms of their business and their volume levels. And if you're worried about inflation, like, what better inflation hedge than a waste company? Their contracts all go up with consumer prices. So you've got a hedge to higher inflation. You've got a utility-like business. It's in a fragmented industry, so it can continue to grow for years. It's related to housing and consumer spending, all the things you want to do. And it's returned for our fund, just in the last 3 years, I think we've owned it for about 5, 16% a year. So that's 60% more than the stock market, or the TSX, I think. It's a utility though, and garbage isn't going away. So I wanted to share a couple of examples with you to sort of put our portfolios into perspective in terms of how we link everything together. So I'll finish it with that. Again, I'll thank everybody for your support. I'm proud to be part of this organization. I think we are, I think we're not only a leader in a lot of things, but I think things are continuing to get better with this, with our organization, and we're going to continue to grow and do well. So I hope to continue our partnership between myself and our internal advisors across the country. So thank you again for having me, and I'll take any questions. Maybe Mark has some.
Well, thanks, Dan. I couldn't agree with you more. And you've really been I would call a ship in moving a ship in those sort of murky waters, and you've really done a good job for our advisors and their clients in terms of the way you manage. I like that you mentioned the fact that the fund, the fixed income component acts as a real alpha generator. And I'm glad you brought up those examples when I think about, toilet paper, HVAC, waste management. These are all everyday examples that advisors can give to their clients when they're speaking about it. So when they're looking at our fund lineup, they could look to the strategic corporate bond fund, the strategic income fund. You'd say the best 2 areas where they can get that exposure?
Yeah, I mean, those are a couple of the areas, but I mean, you look at, you look at REITs, and I know they're having a bit of an issue right now in terms of volatility with the reopening, but that'll likely get better, and you got to be selective. But you look at utilities and consumer staples and some banks. You look at banks, and one of the reasons why we allocated so much to banks last year, is not because we saw this whole big turn. It's because we saw like our banks really going away in Canada, and their yield spread, relative to governments is at 20-year highs. So it was a no-brainer for us to get yield plus the optionality of growth. And we do that, we look at those sort of things all the time. I call it swag. I call it, safety with annual growth. That's kind of what we look for. So yeah, those are a couple of areas, but, we're trying to tie in, a barbell approach to managing our clients' money. One is, take what you can get. Take a good quality business that is undervalued for whatever reason, and you can get those yields, and you can support an income generating part of the portfolio for the clients, and then look for those companies within those sectors that are not only inexpensive, but that have multi-years in front of them of being able to grow their earnings that'll allow their share prices to move with their earnings. So it's basically that 2-pronged approach. And the reason why it generally works is that part, that yieldy defensive part, which I've got a purpose for our clients in terms of yield, that's also the part that in most economic downturns protects us. So I'm in this environment, and that's why I was so confident last year, I knew this stuff wasn't going away. And I knew that as soon as we had some good news on reopenings and the virus, that, these businesses were going to come back, and they have to, you can't substitute. They're not going anywhere. So that was that's the kind of approach we take, and we take that approach every single day. It's not just in this time period.
Thanks. And the other thing you talked about was inflation. And you look at raw materials, you were talking about lumber up significantly. I mean, everything that anybody wants to do to build a home here, we've seen the prices of new homes and what builders can, for cost of materials rising substantially. Do you see a risk in that and in causing perhaps or putting a risk on inflation?
Yeah, and so again, let me first say, if there's inflation, your best hedges inflation are 70% or 80% of the stock market and the high yield bond market. If you want to hedge away inflation risk a bit through securities and allocation, that's where you go. But I will say that the inflation argument, and again, I'm watching this very closely because it's going to determine a lot about where we're going to create alpha for our clients, where we can tweak the portfolios next year, depending on the path. And the two paths are, is it a transitory environment or is it a secular inflationary environment? The Fed is telling us transitory. So when I hear that, I go back to my models and all the things that I look at and come up with my own sort of evidence. And right now, it seems transitory. I mean, Coca-Cola and Procter & Gamble just came out last week, I think, or a few days ago. And they said, they're going to raise prices, 5 to 6% because their commodity costs went up so much, but they expect to revert back to the mean. We'll see about that in the next couple of quarters. So that's transitory. Inventory levels are very low across the board for everything, particular lumber and plywood. And that's going to take a number of quarters to sort of normalize, especially as we reopen. It's going to take some time to catch that up. So there's going to be inflation there, a lot of commodity inflation. So all of that to me spells transitory. So it tells me that, okay, we get inflation for a couple of quarters and then the narrative changes. The narrative on the street is going to be, hey, guess what? Inflation's going back down. Interest rates come back down. Technology goes back up. Growth goes up. So those are the implications of that actually coming true. When I look at secular inflation, we don't have the two ingredients that I look for. We don't have wage growth, particularly in the U.S. Even the blockbuster employment report of a few weeks ago or a couple of weeks ago or a few weeks ago, wage growth was like zero. So we don't have that yet. You need it. And then the other thing is you don't have capacity utilization being taken up. We're at about 76% in the U.S. You're not going to get inflation with 76%, secular inflation with 76% capacity utilization. You're just not. So those are the things I'm looking for to see if they'll change. Right now, they're not. They might, though. Once we reopen, we'll have a better understanding of what's going to happen to wages and what's going to happen to capacity utilization. So, if I had to guess right now, the way I'm marking my goalposts for the next 1, 2, and 3 quarters is inflation keeps pushing interest rates up. Inflation keeps going up. Interest rates on the short end stay down. 10-year sort of continues to bounce up towards 1 3/4, 2%. Really good for banks. Fed is very happy because they get to inflate away their debt. Really happy. And then the question is going to be, will tax cut or tax increases in the U.S. and wage increases in the U.S. and global trade, if it continues to decelerate like it has been for the last 15 years, not the last 2 years, the last 15, those are the things that can start creating a recipe for longer term inflation. But that's not, my guess is that's at least 2 to 3 years away. But in the short term, you're going to see the news. You're going to see these things being pushed around. And that's why the stock market is going to stair step. It's going to have to deal with this information flow every couple of quarters.
Yeah, well, and I'm glad you brought up those 2 points because I think it's important. We hear from advisors all the time who also, hearing from their clients, a lot of concerns on that. So I certainly appreciate your input there. I would love to have you on longer here, but if you have 20, 30 seconds quickly tell me why an advisor would invest with Dan Bastasic.
Well, that's a good question. 20 seconds?
On the spot.
Well, I mean, other than the performance and all the things that everybody wants to talk about, you know, this is personal for me, right? So partnerships are important to me. I only own my funds. I want to be in the same boat as my clients are. If my clients have clients that give me money, I want to feel any pain and any success that they feel. It keeps me honest. And look, generally, I'm competitive. I have a strategy. I have a skill set, and I want to keep doing good things for people over time. And I know it sounds, you know, quirky, but I can talk about the performance, but I already did. I mean, the performance is self-explanatory. You've got to want to do this sort of thing, and I do. And being part of this organization again is important for me. So a lot of things have lined up. That's a tough question, Mark.
I know. I'm sorry I had to, but thanks, Dan. We're proud to have you, and you've been so accommodating to speak to our advisors. A lot of advisors who maybe don't even know you so well, especially on that fixed income side. You know, we've been recommending your fund for well, as long as we could when we were allowed, when it was available on the Seg Fund platform, but we're glad it's available for advisors again. And as well as the strategic income fund, and then even looking at the strategic equity income fund, which I think also has some great, great returns ahead as well. So thank you again. I know there's some questions we couldn't get to today. I'm going to send them to you. If you don't mind, maybe you could answer. We could send them out to the participants. And again, thanks so much for taking the time. And hey, I'm not going to say we told them so in November, but I would say again, if you didn't invest in November, invest with Dan now. It's a great time, especially on those funds on our Seg Fund lineup. So thanks again, Dan. Much appreciated.
Thanks, Mark. Thanks, everyone. Goodbye.
There was Dan Bastasic. So Dan, really, as I said before, just done an absolutely tremendous job on the fund so far. So just going to try and open up my presentation fully. I don't know that I'm going to be able to, but I wanted to just cover a few extra things here. A few things that I have did with one of my larger MGAs a couple of weeks ago that got a lot of very good feedback on compliance, and then close with a new tool that we're offering to our advisors who joined us on the call today. So with any luck, I can be over and you'll be on your way. So just a recap with Dan Bastasic's funds. I mentioned the three. I think if you're looking for something on the fixed income side, which is a real alpha driver, as Dan mentioned, the Strategic Corporate Bond Fund is one of, I would say, the best spots that you could be in, and it's been one of the top performers in the fixed income space for us. Also the Strategic Income Fund, and then the Strategic Equity, which is available on all of our sales. And again, of course, when you look at our fund lineup, there's just so many ways for you to sell to your clients from a compensation standpoint. Also with our guaranteed investment funds, our high interest savings account, you really have all of those. And again, you've got the 75-100, which we enhanced to age 85 with 100% death benefit guarantee, and that's on our full equity lineup. So, if you want a portfolio manager who's solid, this is the one. If I look at Clément Gignac and Sebastian McMahon and the IA Investment Management team, they're also bullish on the Canadian market moving forward, but cautious certainly on the bond side. That's why I think you're going to be best served there. As Dan said, he brings his alpha, bringing alpha to the fixed income space and the Strategic Income Fund. That's been also on our fund portfolios that we put out on a monthly basis. And then if you're looking for something that has a little more global exposure, as Dan mentioned, Strategic Equity Income would be one that you could look to. So performance speaks for itself. And I think that, as he said, looking forward next couple of years, strong opportunities and good returns, certainly with some volatility along the way, but great returns. So I just wanted to touch on a couple of things with regards to compliance. I did this presentation, as I said, a few weeks ago for one of our larger MGAs and got a lot of tremendous feedback. So I wanted to show a few tools that you can use and give you some information just to help you bulletproof your practice moving forward. DSCs are still available, of course, as you know, in the seg fund world. They're not going anywhere anytime soon that we can see. Maybe a couple of years out, there'll be changes, but there's no clear direction on the seg fund side as it relates to DSCs. But what I will say is this document that was produced by the Canadian Life and Health Insurance Association in 2018 considered the factors for selling DSCs to clients. And certainly in the older clients, 65 plus, you'll need to be making sure it's, well, I think at some point it won't be available, but it certainly needs to be suitable for a client when choosing DSC as a sales practice. It's actually the lowest in terms of percentages sales on our platform. We have far more sales in CB5 and CB3. Of course, CB5 pays the same as CB3. But do remember, if you do sell DSC to a client, that they're well aware and understand it. I highly recommend that you have clients signed, and also there's a document we can show you that that really explains or to the client that it is suitable for them for their long-term needs if they were to need access to funds. That's where when I see complaints come through, typically, when you want to protect yourself, it's typically when you have a client who sees another advisor and the advisor coaches that client to make a complaint against you, the advisor who sold DSC. So just make sure you bulletproof your practice. Another document that I highly recommend, and when I was doing this presentation, I spent a lot of time reading the various documents here. This one called The Approach, which came out in 2016, had 7 elements that an advisor would look to when would be generally accepted sales practices. So disclosure to the client, client expectations, the fact finding that you would do with a client, and making sure that you do a proper needs assessment, that it fits the client needs. But most importantly is the recommendations and advice, and the reason why. This is the key. The reason why is the client should receive a written explanation of the recommendation that you are making to them. And then what products that you offer that are available to your client. And the reason why letter is what we have to support you. If you don't already have this within your MGA, I'd recommend utilizing this. It's just good business practice for you because it will help you. It will help with your credibility with your client and also show that you're doing your due diligence. But if you have your own right now, wonderful. If you don't, I recommend having a look at this suitability document. Will be sent out to you and be helpful for your practice. Of course, our sales support is second to none. We've expanded on the team. I've hired 3 new individuals for the investment team. George Chu, who's our new sales director in Ontario. Also, David Marinier, inside sales in Ontario, and Angelo Sangchen, who else just recently hired for our Calgary office supporting the prairies. So we have a number of resources available to you. As I mentioned to you, Clement Gignac they do the weekly 10-minute report that I'd recommend you tune into. We have some great tools for you to utilize with clients, creditor protection, the advantage of segregated funds. And then we wanted to take it even a step further for you. I had a client that reached out to me, and back in the day when I was an advisor, reached out to me and asked if I could give some assistance. They were selling the home for their mother and wanted to know, some sort of what were some of the options available to them. And of course, when I pointed out the benefits of a segregated fund contract, especially in Ontario, there was a huge cost saving. So we developed this estate planning tool for you so that you can illustrate to your clients the benefits of segregated funds versus mutual funds or other, bank funds, if you will, and the real true cost benefit of those non-registered deposits. And as you can see, when you do that, it spins out a really good report that clearly shows the cost savings to the client. So if I have a little bit of time here, I'll illustrate it, but we're giving you advanced access for those of you who are on this call today because we'll be launching that on May the 3rd. and you'll have access to it this afternoon so that you could utilize it for those client presentations. We've been doing these Morningstar portfolios and reports presentations for 100,000 or more. Reach out to the sales team who can help you with those. There's very few portfolios that we've received from banks and other institutions that we haven't been able to beat with our strong fund lineup. Of course, we have our Evo Training Support. If you're not using Evo, it's going to make your life easier. I just can't recommend it more. Our sales team are always conducting virtual meetings. It's all we can do at this point. So we're here to support you, whether it's individual or in group meetings. And of course, our IA Connected, keeping you up to date on the latest that's going on. This is something that since 2014, since we created the investment team, implemented, just because of the days I remember of all the fund companies having these great booklets. We created this Choose IA magazine. If you don't have it, reach out to the team. It will also be sent out today for you in electronic version. Sorry, Benoit, I think I've maybe added a task for you there, but will be available. And of course, here's the sales team that's, I'm proud to say we've doubled over since 2014. I'm really proud of the work that all of them do, and we're here to help grow your business. That's really what we're here to do. We've had tremendous success. We've moved from 4th to 3rd position, and again, we've been leading the industry #1 net sales, far exceeding our competitors. And we don't do that lightly. We certainly want to continue to grow. We've got really exciting things to come. As I said, we enhanced our investment loans. We've been doing more investment loans than we've ever done before to date now. And if you're like Dan and are bullish on the markets going forward, this is a great time to look at our investment loans. So extremely competitive. We're adding new funds in the fall. I know you're going to be super excited about also adding more third-party funds so that we certainly are keeping in that independent spirit. So we'll continue to do that. And if I have a little time here, I just want to share with you, if I can, the estate planning calculator with hopefully with the, and unfortunately I may not be able to, but let me just try something else here to show you how to utilize this for your clients. And it doesn't look like I'm going to have any success unless by chance Benoit, you're on the line and have some magic in your back hat there. No.
I'm gonna share my screen so that you will be able to use it, Mark. Just
Perfect.
Wait a second, and I'm gonna give you the control. So right here. There we go. So you can take the control and you can go. Yeah, that works.
Super. So as you can see here, you can pull up the country, or the province. You double click on your province, marginal tax. It'll automatically pull up top marginal tax rate there. If you pull the capital to invest, let's say we're going to do $1 million here for a projection period, let's just say 10 years of fees, because there's a slightly higher cost on seg funds. We're going to do an overall return of 5%, 4.75. You're going to see here what the market value is at death. And then it'll also incur, and you could also change any of these amounts, professional fees, which would be legal fees, the $23,683 that would be payable in Ontario. I know Alberta, of course, is different. Mind you, if you're in Alberta and you own property in BC, that there's taxes to be paid there, but you could just see how that savings would play out. So $47,000 in savings. You can generate the report for your client, put in the client name here that you're doing it for, and away you go. So just hit generate the report, and I'm not sure if I'm going to be able to show that here, but
I will show the Wait a second. I'm gonna show that to you in just a quick second.
Perfect.
Mark,
So,
look at this. I'm just gonna share my screen back again. There you go. So have a look at this, and I'm gonna give you the controls as well.
perfect.
Okay. Yeah.
So you can see how it generates a nice report for you, and it'll outline just how the many advantages of segregated funds impact the estate planning for that individual client. So, so we hope these tools are helpful to you. It is available to you now, and you can see here you get the itemized report. It's available to you now or this afternoon. We'll send you the link to that, and as well, all of the presentations or all of the documents that I discussed here today in the presentations will be made available. Again, I want to thank you for the time that you have spent with us here today, and everyone have a great week, and reach out to the team if you need any other support. We appreciate your business, and look forward to the next Let's Talk. So thanks again, and bye everybody.